everybody hear me?
Yep.
All right. Thank you, everybody. Welcome to Crypto World. I'm really glad you guys could all make it. My name is Jonas Buxton. This is Jeff Wade.
Hey everyone, thanks for coming today. We have barely advertised, we got a big group, so thank you for all for being here today. But we have Michael Carter. Yeah, we have Michael Carter here today, BitsBeTrippin. He's our mining guru, overall crypto guru. So he's going to talk a little bit about.
Yeah, we'll start. I don't know the level that everybody's at right now from just if this is your first time with crypto. So we'll start with kind of like what is crypto and kind of lead it in pretty quick into mining and aspects of mining. Difference of proof of stake versus proof of work. There's some of those questions out there. And then we'll probably pause to let folks ask some questions and make sure you guys, it's an interactive piece so you can ask questions. Don't be afraid. This is very new to a lot of folks, and every question usually leads to new information for somebody else, and they're like, oh, I didn't know that part. So
yeah, this is our very first event. So we usually do crypto over coffee Tuesday mornings at 9 a.m. But this is the first Bitcoin over beer event. So hopefully we'll have more events like this. Big thanks to
Beer Sauce.
Beer Sauce. They're providing the beers. Thank you so much. Yeah, so check out Beer Sauce. I think this is dead, but it's okay. But yeah, I mean, I'm going to hand it over to Michael if you have more questions.
It's a small room. I'll get this charged so when we pass around for questions, everybody can actually hear the other person.
Yeah,
But,
excellent. Yeah, I'll start.
Welcome, Michael Carter.
Well, thanks. Yeah, if anybody, I'm going to first kind of just let everybody know, like if you have never seen any videos, we are from BitsBeTrippin. It's a funny name, I know. We were thinking something catchy in the very beginning. The channel was created back in 2013, so it was around to try to educate people around the mining space. And what that meant was, at the time, there wasn't a lot of help. There was forums, there was a lot of different like kind of videos out there, and it was really hard to actually get in and get something working. Where I like to say is like you can get lost in one of our videos, and there's several other videos like it in a night, and you could be mining that night and then wake up in the morning and see the result of it these days. Back then it was like, maybe it's working. You know, you didn't really have a lot to go from. So I was like, you know what, there needs to be a YouTube channel or something, and just kind of fell fast, try to get people out there to start getting into this space, get some feedback. It was kind of my way of like, maybe I'll say it wrong or I'm saying it the incorrect way, and then somebody's going to correct me, right? So you get that from the internet if you ever use the internet, right? Is if you say something, there's usually somebody that's going to come out and correct you. And in this space, it's a lot of discovery, and a lot of the content that is out there is shared amongst folks. So this is one of the coolest communities, I would say, anywhere, especially when it comes to the mining space.
There's a lot of people outside, believe it or not,
okay.
too.
Yeah, no problem. Like the community in this space is very different than a lot of other communities in general society, and it comes from people ask like, why is the mining community so open and sharing? When you think of what mining does, it reduces, the more people that mine, the yield is reduced. So why would you want to give that information away to people? People ask. Well, the inverse of that, the Bitcoin gets its strength from its security. So the more security, the more people mining it, it shows that integrity to try to reverse or change any of that code base or change, it makes it a mutable record. And that's, if we're talking about it becoming one day maybe the world's reserve currency, you want the most strength on that network possible. So the fact that all of us as miners take a little hit on yield every once in a while, we've seen the price reflect the strength of that network in price discovery, and it keeps going up, right? So it's one of those things that the more people that understand how to do it, the best practices that are shared, and I'll go through some of that, when different miners find new ways to maybe cool things or more efficient power in a particular part of the country, that kind of stuff. That's why we're always talking with each other with it, of like, hey, I was able to get power in the Northeast for 3.5 cents per kilowatt. It's like, really? Well, and then you share that with a local power producer, and then you start to discover, well, wait a minute, power producers can produce power at a certain scale, and they spin them down because it has to go somewhere. We don't store power. The batteries are expensive and inefficient right now, so they'll spin down a power plant. Well, a power plant will say, well, wait a minute here, if I can sell 20% more, I'll sell that for a little less for that commercial user. And lo and behold, we find that we can actually get cheap power in the US. So it's kind of one of those things that I don't think anything would happen unless we share information. So that's why you hear stuff a lot from me and other folks that talk in this space to try to make sure people understand on how to get involved. If you want to get involved, the level of effort that there is, it's not easy, and it's not a quick, like get rich thing. It's like you put a lot of effort into it, you start to understand it, and then over time it pays. And you start to understand that, okay, I'm a contributor, I'm getting it over time, and I'm hedging my risk, because if you come around and just buy right in to crypto, you're trying to time a market, and timing a market's like really hard. If we were good at timing markets, people would be all very wealthy, right? So it's, mining allows that hedge to where you get in and you get this trickle over time that has different levels of yield based on the participation on the network. More people mine, you get a little less yield, but usually that's because price is high. So, and then when price comes down, we've seen that with a couple times in Bitcoin and other currencies, you'll see the people will turn off miners because it's not profitable for them, or maybe they were fair weather and they're like, yeah, no, that's not what I thought it was. And they turn off their rigs, and then you're, as a long-term miner, going, I'm getting more yield this round, right? And then you'll get it that way, right? So it's just understanding the basic principles of mining and that security. I like to always get out kind of in front, and I know I've unpacked a lot there, but I just want to make sure that people understand why people would give information like this for free and that collaborative piece. You'll see, especially now that more and more like industries getting into it and trying to figure this out about giving information. We've seen Marathon and HUD-A and all these larger companies also now being a lot more public on the sharing of information, which is really good too. I think that provides us some structure and then confidence if somebody's been on the sidelines for a while. So if you've been in this space for a little bit and you're wondering regulatory and all that kind of framework, as these larger entities start to share that information and then they start working with some of these other regulatory entities, we start to now get enough large players in it to where they start doing that heavy lift for all of us, folks that are just incrementally getting into it. It's kind of I would call it kind of a coalesce of a relationship that a lot of people at first were like, I don't know if I want the big guys in, and I don't get anything, but it helps the overhead kind of fall to them because they're going to have to be a little more compliant. And we're seeing that right now with the infrastructure bill and things that people don't understand yet in this space of how people are participating, and does America make changes to laws, and how's taxes going to work with this and all that kind of stuff. So, yep.
I want to see if your microphone's on.
Did it turn off? It powered off. Yeah, I think she's down. She's down, Jim. There it is. I'll keep my fingers away from that. There we go. All right. Can you guys hear me? Yep. All right. So I kind of jumped right into it real quick. I'm going to do a quick show of hands from a mining standpoint. Has anybody had any exposure actually physically doing any mining in the room? A few of you guys. And of that, is it just Bitcoin or is it any kind of GPU? Mostly GPU? CPU, there you go. Look at my RTM and Monero bros back there. There you go. All right, so we'll start kind of at the basic, simple piece from just mining and standpoint. So this will be very rudimentary for folks that have been in it for a while, but this is actually a really good understanding of how the aspects of mining work. So, when Satoshi came out and invented crypto, blockchain technology, right? You're looking at Bitcoin, white paper, time. The innovation, the so what factor is figuring out how to be able to create a transaction between two parties. And that transaction being able to not have to use a third party, right, was reinforced by the concept of mining and consensus. So we'll get all of these different folks that could independently run a piece of hardware, right? And at that time it was CPU. And it would run a calculation. And all of them at the same time would do the exact same math problem at the exact same time. They're all chasing to try to get an answer. And that answer is the solving of that SHA-256 hash. It's saying, if you got that ticket, then you get the rights to mint the next block. And for that, think of a block like a train car. And there's transactions that we make to and from each other. Those are all setting kind of off to the side as like people waiting to get onto the train. They will pay a small fee to get onto that train ahead of each other, and it's a bid war to see who could pay the most. Now, from a miner standpoint, they're like, you're going to go in order sort by the highest paying because we want more transaction fee, right? So, and we see this with Ethereum, and we'll get into Ethereum on a cost standpoint, but that gets packed into that block. So that miner that wins that block gets enough on to fill that block if it can fill it, and then gets the right to mint that block. And now it's part of that ledger entry. That effectively is what mining is. Now, to change that, every block that is created, each subsequent block takes the information to the car ahead of it, right? So that's that chain of blocks. So for you to make any kind of a change to that, like if you were trying to do like a debit credit kind of fix in a ledger, normally you go in there and you're like, wipe that out. Nope, this is what it is. You can't do that with blockchain, right? That's the functionality, is that what's happened has happened, right, wrong, or indifferent. Garbage in, doesn't matter. Because you can have an accrual later on, another post that says, meh, what we did here was kind of incorrect, but it's referring to this other block. So you have that chain of custody. That's the innovation, is a way to do that mechanically without having to have a third party to validate it. That mathematically it's reinforced by the process of the mining, and that you end up getting an arms race because the holding of those tokens, the issuance of those tokens, let me step back one sec. Why would anybody want to hold this network up? Satoshi obviously invented this mathematical way of consensus. And then he's like, how am I going to get all these people to convince to run this network? They got to have cost of power. They got to run it. It's got to be independent. Like, how am I going to convince everybody to do this? I'm going to issue a token. It's going to be limited by supply. And it's going to have a series that comes out. It's going to start with 50 blocks every 10 minutes. And after 4 years, I'm going to have it. That sounds good. And then that inflation rate's going to go down by half. One block it's 50, next block it's 25. Now that's happened a few times. It went from holding 50 down to 25 back in January of 2012. Nobody knew what Bitcoin was. It had a little bump and it was 50 cents. Then it went to like $11 in December of 2011. And then it was like, wow, what's this thing called Bitcoin? First time I remember seeing it on the news in February of 2012. Got on CNBC, they're like, this thing Bitcoin now is $212, right? The test was working, right? People were understanding the value of being able to put information in without a third party, and the fact that the network was the record keeper. And we could all independently verify that these records weren't changed. And in a world that was kind of getting to a point of like fake news and all that kind of stuff, it's like, well, this is something that is atomically correct. And the atomic correctness is on all these different nodes, and they all match. That's interesting. So you see this effect happening. And you get You get 4 more years later, and it happens again. It goes from 25 coins down to 12 and a half coins. And now we're in the next 4 years, which just happened about a year and a half ago, where it dropped down to 6.25 coins per the 10 minutes. And then the 10 minutes is a calculation step. It's not always 10 minutes. If you go out there to the Bitcoin blockchain, it might solve a block in 3 minutes. And what happens is that mathematic problem, as more people add more miners to it, it races to 1,024 blocks. So every 1,024 blocks, it goes, how fast did the network solve these? And was that target time 10 minutes? Because that's its inflation calculation that it needs to hold. And it goes, nope, they're going too fast. There's too many miners on. Let's retarget the difficulty. So that's how you get your difficulty adjustments, right? So every 1,024 blocks, as more people are added, it slows it back down. It makes it more complicated of a problem to be solved, right? So that's how all these people and these miners sitting around here, which is sacrilege that those aren't plugged in. No, I'm just kidding. Being part of that network, these things are like $80 an hour or $80 a day right now. I'm squirreling on you guys. Sorry. That as more are added, that's how it speeds up that block time to get to that next difficulty adjustment. And what you'll see if you go out there and look on any of the Bitcoin websites that show difficulty, you'll see like a stair step, and you'll see what happened in May of this year, where China said, "Hey, we're shutting down all mining," and you'll see it just drop. And when they shut down, we were close to a difficulty adjustment, luckily, because 70% of the hash rate came off. Those blocks started taking like 2 hours to solve because computationally there wasn't enough to solve it at that other difficulty level when everybody powered off. But when Bitcoin calls it a death spiral, if enough shut off, it would take a long time to try to solve the next block and then get to the next difficulty adjustment. Luckily, we were close enough to a difficulty adjustment because rarely would you ever have 70% shut off. So the best thing that ever happened to Bitcoin happened in May, which is where the concentration in one country was now divvied up across many countries. So now you have 30 some odd percent in the US, you have some in Canada, Central America, which is crazy because it's warm down there, and it's just having to cool it. South America, Kazakhstan and Russia, like it started to spread out, which is the best thing that can happen when you're looking at decentralization. You don't want huge concentrations of it anywhere because you want to be able to be no single point of failure. It's one of the biggest things for Bitcoin's thing. You don't want any one entity having any one control. Everything that comes across it is equal, right? It's atomically equal. We all have to have the same ledger. Any entry of that comes onto it, that's not, it gets denied automatically. It says, nope, you're not, this is an incorrect entry, right? And then you want to have that immutability where people can't just go in there and change any, through any kind of like, what would you call like a hacking event or something where somebody's trying to spoof something or any of that. It protects against all that. It's protected against all that since it's been around. It's one of the only things out there in the world, and this is the reason why you see the price the way it is, that has that level of integrity because of all the mining. So I'm trying to give some base history on that because a lot of this stuff applies to a lot of the other networks you see out there that do proof of work. So if it's Ethereum, Ravencoin, you look at Ubik, you look at any of these things that are proof of work, they model essentially the same kind of concept where you have computational power. It's an arms race to try to get, its difficulty. The only things you're changing is block time, and things like Ethereum doesn't have an upper limit, where Bitcoin has 21 million, Ethereum has no upper limit. Ethereum doesn't have an upper limit because computationally it does certain things that cause a burn and burn some of the supply. So as you do these activities, it's going to remove supply. So if you had an upper limit, essentially you'd be racing to where everything that you're building on it would shut down because you would run out of Ethereum. So you need certain aspects of it. So I'm telling you this because when you go out there and you look on the internet, everybody's like, oh, it's unlimited supply, sell it all. It's like, a utility of it's different, right? It's not about world reserve currency, value going up, store of value concept. It's more of like utility and use, and you're going to do smart contract functions on it that happen to spend and burn part of that function. So they're, apples, oranges type of conversation when it comes to that. And you got Ethereum moving to something called proof of stake. We'll move to that in here in a little bit, what proof of stake means. But block times, so Bitcoin 10 minutes, Ethereum 15 seconds, faster block time. That just naturally gives it a little faster amount of information that can go onto the network. Bitcoin's about 7.5 to 8 transactions per second. Ethereum's a little over double that. It's not quadruple that, even though it's 15 seconds. 15 second into 1 minute would be 4 times. It's not proportional because Ethereum's has a little more going on with it. There's a lot more information going on with it. There's smart contracts, there's things have to sync like that. So it's about 15 to 20 transactions per second. And then you have, so those are those base layers, and then you have other networks, Solana, Polkadot, Cardano, those kind of networks that are proof of stake networks. And they operate a little differently. They do not use mining. They went to a concept of, we don't need to have all this huge computational powers. We'll mint a whole bunch of coins up front, and we'll create this distribution model of people that would then host these nodes. And for those nodes, you would take a stake, you would purchase coins, and then you would stick them in the node. And then that gives you validation to be able to do that same validation step that we're talking about. But they're going to pick that ticket differently. They're going to randomize it. They're just going to say, you don't have to go through all that work. We're just going to select anybody with enough staked node will then get an option to win a ticket randomly, right? It's just using a random function to do that. And so you'll see that with Ethereum. Now, there's a lot of questions that you'll see in the space that, is that better? It's better, atomically it's better for an environment. It's questionable. when it comes to, it definitely not going to use the same level of power as Bitcoin, but then it transfers that risk of a node of where is it going to be hosted. It's a little more complex. You have your coins wrapped up into that node, so you definitely have that private key locally. With mining, you're taking a solution, you're mining, you're winning a result, and you're going to possibly an offline wallet that's stored in a bank. With proof of stake, you're putting stake of coins, that wallet, online, hot wallet, hosting it somewhere. So now that's accessible, right? It's online. So the risk and security is a little different, right? Because now you got a hosted environment that is online. With mining, you could buy these mining machines and send all that reward offline. You create a wallet and then you're pointing it offline and it never has to set online. It's still going to send those coins. Because remember, nothing in crypto and blockchain is here physically. You are just a pointer. If you have a hardware wallet, a paper wallet, whatever it is, that's just your key to access that on the blockchain itself. But that thing's locked until you go and use that private key, right? So you can operate, quote unquote, offline. So there's just some different security things. We talk a lot about that on the channel. I'm getting more into that as we get closer to, Ethereum being proof of stake. The reason why I don't cover it as much right now on like Solana and all that is because a lot of the way proof of stake so far, if you're looking at Solana or Polkadot or Cardano, these larger upper cap top 10 coins, is their networks when they were produced, they were very high cost of entry. Like Filecoin as an example was something like $150,000 to $200,000 worth of equipment you needed up front to host their node. Solana has very, very high requirements too. And then the selection of the block producers is done in such a way that's more of kind of a privileged access, to where like mining, you can just get a miner. Like if you're doing Ethereum or you're doing Ravencoin or any of that, you can literally, this used to be a lot easier conversation because you could just go down to Best Buy and grab a graphics card. Lately they've been all out. We can think part of that as a pandemic, we can think part of that as supply chain issues, but the barrier to entry was very easy. You could literally get lost on a video one night, not know anything about it, and be mining that night, and then wake up in the morning and have a return. And you were like, wow, this thing actually works. And then people would send messages and go, why does people want to, I don't understand why I'm getting paid. Like, this thing's actually worth money. And it's like, you're just a service provider. And for that service providing that you're doing, you're getting compensated in a token. That happens to be worth money, right? That price discovery is there. Because maybe somebody tried to mine, and it was like, yeah, not for me. I'll buy the coin. Now you got a counterparty that's buying it, right? So you got all these different participants that come in at different levels, and some maybe are technical. Some, I've had people reach out and like, I've maxed out my apartment in New York, and I got my windows open in the winter, and people are freaking out what's going on. But I only have two circuits. Like, is there a better way for me to expand? Move, like I don't know what to tell you. Like, that's the apartment. Be careful, don't burn it down. There's different ways for people to participate. So then some people take a dollar cost average approach, on different coins. The reason why you see maybe people are like, man, Bitcoin mining is pretty expensive. They're 14 grand a unit right now. I still want to mine. I like the concept of it. That's where your GPU mining comes in. You can do CPU mining. There's some coins out there that do CPU mining. They have different utility and access. So you'll have this series of folks like on Bitcoin Twitter that will be, or crypto Twitter, that are going to be like, oh, the Bitcoin maxi, that's the only thing you want to do, Bitcoin. You got to look at it, I look at it, and I've always looked at it more holistically, is each of these things, that the brilliance of what Satoshi invented here was the ability to participate in something that's decentralized. And that concept, when you start thinking of information, you start thinking of other applicable use of that, I think that's where we've seen the exposure and the explosion of stuff like NFTs, these very unique characters. Again, I'm going to say the same thing. In a world of fake news, anything that's atomic that you can independently verify on a network that it occurred and it happened, it's worth something. It's worth value to even have an access that as a utility. Now, what do you tie to it is the question, right? So when you look at, Ethereum or Ravencoin doing NFTs, any of that kind of stuff, that your ability to participate with that is literally going to a store and getting a piece of equipment. And you can independently connect to that and get a reward for adding security to that network. And that's the physical part. And the other piece of it is the hedge that mining is, because crypto is volatile. Sometimes it goes way up and sometimes it comes right back down with different reasons. And the mining, especially on like the GPU side or the CPU side, stays pretty flat to high when it comes to your resell. You're like, okay, it got too low. Ethereum a year and a half ago went to $86, right? Which is, I know it's 4,600 and everybody's like, why didn't I buy more? It was $86. So the miners, like a lot of miners shut down. Our BBT Farm was shut down for a little bit because we're like, okay, it's like, $8,000 to $14,000 a month in power costs, and you maybe make $6,000. Okay, let's power it down. It's time to clean. Just maybe it'll bounce back for a little bit, right? So yeah, you make that decision. But the hardware, we didn't lose any cost in the hardware. We bought those units, $209 GPU to $229 GPU. I know, don't throw things at me. It was 2016, it was a different time. So, that kind of, and even the $2,000 GPUs that you have now, the sunk cost and the resell on that. So it's a hedge, right? It's like, there's a new thing, I'm gonna try it. Am I gonna lose too much money? If you buy a coin and you time it wrong, and then you need that money later and the coins have went down 60%, you're like, oh crap, I lost 60%. So that's why mining, people like kind of balance, like, do I wanna go through mining? Do I not wanna go through mining? What's mining provide me? Mining provides you coins over time, and it also allows you to hedge your risk on hardware that is resellable to other things, right? Now the ASIC miners, purpose built for the thing that they're mining. So if you look at any ASICs or FPGA is a way to get into it. I usually tell people to steer clear because unless you can develop and write bit streams, probably not worth it. Because it's a programmable GPU, which means somebody has to program it. And usually those folks are programming like medical and AI devices, not crypto mining, right? $500,000 a year folks, and there's a few of them that are really good at it. And then maybe on their side, they're the ones programming the bit streams that they'll maybe be nice and release. So you got your CPU, your GPUs, and your ASICs. FPGAs are kind of in the middle there. And the ASICs are usually pretty expensive, and your risk on ASICs, with anything, is the fact that if it goes down too low or something else comes out that makes those, inoperable. Well, not really interoperable, but like it's using twice the power and like half the hash rate than this new thing. The good thing about like these ones sitting in this room is these are the latest tech, and Bitcoin has driven to be the tip of the spear in the tech stack. So for before it was 14 nanometer, 12 nanometer, and this is just the fabrication, the chip. Now it's literally at the tip of the spear leading the fabrication because they are digital printing presses. So it's pushing to the foundries to the edge of what's capable right now. And what you see right now is capable. 110 trillion hashes, 64-bit alphanumeric per second on one of those machines. It's mind-blowing about how much information that is per second of one of those devices. And they use 3,500 watts of power, so it's a lot. But that device is only for SHA-256 based calculations. So while there are other things you can mine with those devices, Bitcoin, if I had a Pareto chart, it would be like Bitcoin, and then everything else would be like this. Just because the amount that you get a lot more yield on Bitcoin Cash, but it's not worth near. I mean, Bitcoin Cash is still what, sub price check on Bitcoin Cash? No, 600. Right. So 600 versus 63,000. Right. I mean, when Bitcoin and Bitcoin Cash split in August 2017, they were like half of each other at one point, to give you an idea. So, sorry for the Bitcoin Cash holders, my dudes. It's just what happens. So Bitcoin Cash can be mined with that. Bitcoin SV, there's a few other things out there, but they're, that's not really, I would hang my hat on, that would be your counterpart there. So that is the risk. I always like talking to the risk of what the network is, and it comes back down to that. We'll take a pause.
I had a question about, so of all these, thousands or millions of miners, units around, every 10 minutes, one of those finds the answer first,
Correct, one of them.
and they win.
Correct. So what happened is very early, Satoshi figured out like, well, that's not going to work unless they're pooling. So then some folks that were helping Satoshi designed some pools to be like a center point for people to send their hashes to, right? To say that we're going to send our hash rate to this, and collectively, think of it like a numerator and a denominator. You're given a share. So if you ever point a miner to a pool, you're getting a share. And what it's doing is, think of a number line. Well, back in this was maybe 4th, 5th grade, we had number lines, right? What it does is this number line is really big. And what the pool does is the pool takes that big calculation and goes, it's somewhere in between this. So we got the outer and the inner, the edge bounds on both sides. And then a pool will send you a block within that and say, your miner is going to work on that. And it's going to work on it really fast, and it's going to send me a share. And it's going to calculate a difficulty. And proportional to how many shares you have, you're going to get a counter that's just clicking up, saying you have X amount of shares. So the more miners you have to that pool, you're clicking up that counter of shares versus the total denominator of everybody on that pool. And you are paid. So if somebody in that finds a block, that pool finds a block, it wins a block, and you'll see it on each of these. If it's Ethereum, if it's Bitcoin, you'll see so pool found a block. What that meant was somebody that's going to that pool found a block, and then the pool shares that proportionally to the hash rate. They call that PPLNS, right? So you're paid by your linear shares. It's actually something different. I can't remember the acronym. But PPLNS is the way that's done. So it does it proportionally. And there's been, I mean, we've done a couple like tests between pools to see if it's screwing us. You know, like, is this pool giving this based on their share count? What's this pool doing? It all comes back down to what's the difficulty and how do they calculate shares? And you get kind of in the minutia of the math, but at the end of the day, proportionally to what the hash rate of the pool is reporting versus what you're paid out over those different pools, were very close to each other. So it's not in the best interest of the pool to like openly like screw people over, because like there's so many people looking at it, and it is a transparent, like, what's the pool, we know who the pool won, right? Because they're broadcasting their node, they're creating the block shell, putting the transactions in. So much of it's transparent. And it's like a model to way like a lot of things could get. Like, let's just start modeling things like this. You know, we understand a lot of core data needs to be in data center somewhere, but the events of the triggers should all be transparent, so we know at least certain things happen. We get to see that with like the pool side. So then it is all the way down to like a single machine, a device doing that calculation, all the way down to we could actually, it's not at this level, but you could get it all the way down to the chip on that board that actually did the calculation. To the point of like in 2018, they used to have these, like when they first came out, the ASICs, they had like USB ones, and people still use them, right? They're 15 watts. They get like, I don't know, like a giga hash, right? Very small. 1 billion hashes per second, 110 trillion hashes per second in one of those boxes. So to give you an idea, very small. One of those devices was just mining to a pool. Or no, it wasn't mining to a pool. It was doing something called self-mining. So it's just taking the problem and just saying, that's too big of a problem to solve, but I'll just work in this little spot. And it's just submitting answers to the daemon, which is what's running the node. It found the answer. It's like a $15 thing, right? 12.5 Bitcoin. That was a heck of a payday. So the guy was just random. It was very lucky, very improbable to happen. But that's why you see, like, so every once in a while you'll see people like, I still run the USB miners. Maybe there's a chance, right? It's very little. Like somebody did some calculation. It was like you could have got struck by lightning 4 times in a row in the same spot. It was like the level of luck that was. But you know, it is to that point. That's why I like bringing that example up. Is it is just one chip on one of those devices that find that answer and then submit it to the pool. And it literally is just a calculation key. It's saying I got a key to that door that now you can take transactions to and broadcast it. And what happens is you'll have this happen, and sometimes because you have computationally so much going on, 2 people will find the answer at the same time. That happens too sometimes. And now you've had a race condition, essentially, through all the nodes. You'll have both find the same answer because the answer's out there, and they're all trying the same series against this, right? So they both will find the answer and they both will broadcast it. And it ultimately comes down to one of them starts to get invalidated because it does a key stamp of it and says, those were the same, but this has a higher node count. Sorry, and then you'll start seeing rejections. And they actually will start rejecting on both sides, and then it'll get to the point that, well, nope, this is the truth, this is what it is. And you'll see that work, you know, that, nope, that's orphaned work, sorry. Ethereum actually pays for that when that happens. Ethereum does an uncle pay is what they call it. It says it uncled it out. It's saying, yep, sorry, you lost, but we'll pay. We'll pay a small amount, right? So Ethereum actually adds that. The crappy part is it adds it to the person that won the block because there's no way to pay the other person, right? So it just says, oh, there was an uncle, and we paid that guy too. More money. So it's kind of an insult. But it's like this extra incentive to say, well, sometimes you win some, sometimes you lose some. And then if you were chasing against somebody, you won now more. I remember a couple times. Remember that's how we hit a couple uncles. We were doing some solo mining back in Ethereum back in the day. It was like you're getting like 5 Ethereum at a time at that time, and then you're like, you look at the wallet one day and you're like, oh, I want a block. Oh my God, I got 9 Ethereum in 1 block. So yeah, those are some nice wins when you solo and back in the day. That's some of the fun and exciting part of mining. Is, you know, it was actually in my little jingle that I had in the very beginning, very first video I ever made a little jingle, and it was like, you're making money when you sleep and you wake up, you know, and it's like, oh wow, what did we do today? It's passive income. You know, you're providing a service, you're paying for the hardware, you're paying for the power. You know, you're not cheating anything. You're literally putting in work to get that done, and you're compensated for it. It just happens to be passive, which is pretty nice. Let's take some more questions. I've been talking for a bit.
What do you think about the block size of Bitcoin? So you said like the time scales that the blocks get processed, but what do you think about the size of it? Because currently Bitcoin's like, well, I mean, it's always been
2 megabit, yeah.
Yeah, so
there's actually some really good books on this too. It's called The Block Wars. And if you have like Audible or something, you got free Audible things, I recommend to listen to it. It's great Bitcoin history. But there was a debate on this, like on make the block size bigger, go 10, 8, you know, megabytes in size, allow more transactions through because more people started to use it. Because when in the origination, Bitcoin was all around digital cash. Like this was going to be a replacement for cash. You know, peer to peer, you don't have to have centralized third party. We'll just use it as cash for everything. And then math happened, and we were like, wait a minute here. Like as more people were using it, my transactions weren't happening right away. So like, what's that mean? Oh, the block size is full. Well, just make it bigger. Well, then there was this debate on like, well, is that the way to really approach it? Because we're not anywhere near even a small microcosm of people using it, and we're already hitting the block size. If we quadruple it, who cares? It's never gonna have enough space to fill this. We need a new solution that is complementary to it. And that's where brilliant developers sitting probably at a bar figured out like bar tab transactions, right? They thought of what eventually came the Lightning Network. It was, I can go to a bar, I can open up a tab, we make microtransactions all night, sometimes very expensive ones, and then we post that in a single transaction of all of the delta of those transactions in another layer, but we wrap that as a Bitcoin transaction. So the hash of that points to this other network that now has that detail of all those microtransactions. Now we can transact really fast. We have lots of other nodes that are hosting that microtransaction, and we can still store the results on the Bitcoin blockchain. So now you have this layer 2, and you'll hear layer 2. Just think bar tab transaction. Make lots of transactions in a series of time, and I can post all those as a single post. When you're cashing out, that's the point of the bar tab transaction, right? At the end of the night, you're like, cash me out. One transaction, really big one sometimes, lots of microtransactions that were tied to it. So it was a kind of a novel way to approach the issue with that and saying, well, maybe we can do that. Well, to do that, you have to do a few things that some folks that were very pro keep layer 1 in place. They didn't like the fact that you had to send a certain amount of Bitcoin, lock it up on there. So now you have essentially staked out there to say, I have a Lightning channel and it has enough value to allow other Bitcoin transactions to occur at speed. So you're locking up channels. It's not a perfect solution, but it is a next step forward to kind of move the space on. And that's where you're seeing places like Strike doing things, which is how El Salvador's doing, microtransactions in their country to make it as cash, right? To do that rapid speed stuff. They're using Strike to do that, using that same kind of tech, right? A layer 2 solution still resolves down to the Bitcoin blockchain. You can take a large position in Bitcoin and then create lots of microtransactions between it. Good?
So can you comment some more about the trajectory there in El Salvador or
Yeah.
in China? One of the.
Yeah, it's interesting. So, like El Salvador, for anybody who doesn't know, El Salvador recently changed their country law to now make Bitcoin a currency, a true currency, where like in the U.S. we treat it as property, right? There's only so many out there. It's like an address, that we would have. It's physical property because there's only 21 million. So when IRS and folks got together and they were thinking, how are we going to tax this? They're like, well, wait a minute. If you only have 21 million and you only have so many out there right now, it's just like property. Like it's just moving around. Let's tax it as capital gains. Let's not look at it as a currency. El Salvador's like, no. We're using it as cash. It's its own thing, right? It's a currency. So they pushed forward with the framework to get there. You have other Central American countries looking at doing it too. And it's hard for, I think, a U.S. citizen to understand like the complexities and the risk with like moving money cross-border and all the costs that are involved and people that come here to work and then send money back to family and the current infrastructure that's in place for that. We hear stories about it, but if you have to actually do that, or if you're just doing business and sending stuff, we've sent money, I've had to send stuff to Bahamas or send stuff to Dubai. 3 days later, somewhere in the ether, it may show up, or then you have to do a wire trace. There's a lot of complexity and overhead and sometimes who owns it searching across that. To have something that's just rapid like that, like Bitcoin, it really fundamentally changes things for countries, especially third world countries.
So in El Salvador, then, you think that it's on a trajectory to be practical?
I think it is. I think it's all like infrastructure building. It's like we have solar everywhere yet. No, there's gas stations are a lot faster. I think it's a crawl, walk, run approach. I think what they've done allows people adoption. They have a country wallet, which is based on that Strike. So then everybody that has cell phones down there, it incentivizes people to use their cell phone. And the incentive structures that are around anything that's semi-subsidized, right? They gave some to people to get them kind of, hey, here's free money for a second. Try to understand how this works. I think the adoption really comes into how does that make it a little better. And what I think what it comes to is the cross-border stuff, because it's hard for people to adapt Bitcoin as currency when we have things like Cash App here and stuff like, I could do that on Cash App. I send it on Wemo or Venmo, and it does the same thing. It feels like the same thing. The apps even look the damn same. Like, what's the difference? And I think it really comes into when you cross territories that are not set up on Venmo or set up on this, and it's like anywhere in the world. Like, if you have a connection, it doesn't matter. There is no pre-sign up. It's permissionless. Like that, I think, is when it triggers people like, oh, it doesn't matter. I don't have to exchange anything. I literally come into the country, I scan it. It doesn't matter. It doesn't. You don't get that trigger on your phone like, oh, sorry, we don't operate in this country, right? It's that is where the aha is, I think, for people. So it's hard for people that are just there and not really going out. That's like, who cares? I'm not going to use it. Your government gave me $30, sweet, like. But I think it does when you start talking cross-country trade, when we start getting away from creating big borders, and we have this more of a consensus of the way things work across countries and stuff. I think that's where it really starts to shine, because now we don't have to come up with all this crazy infrastructure and interface agreements. Anybody that does application building, and this has been a lot of my life before, is building big systems that talk to other systems. Interface agreements will eat your lunch. Creating security chaining between all these things to make sure everything works. Eat your lunch. Those things expire, and then somebody makes a change downstream, and then it just doesn't get there right. And there's a lot of complexity. Bitcoin, with that kind of concept, changes a lot of that, because now you have a system that's already built, and we can send and receive information. If you think Ethereum in that same concept, or smart contracts, borderless, again, I don't have to go create these special considerations between all these different entities, companies, all this stuff. Just everybody subscribes. It's like changing the view to where everybody now is going to the same view. And now we don't need to all create all this other infrastructure. We make all that one time in the smart contract to make sure that what we need up there is all the things we need, and then just everybody points to that. And then if you make changes to it, it's a global thing. And that's why you see a lot of these other currencies spin up, is somebody goes, I got an idea. Oh crap, I can't change Bitcoin. I can't change the Solana. We're gonna call it something else, you know, and then they spin a token and they just clone the code and then they make that new thing. And that's why you have a lot of these. And then that's a good part of the ones that are actually functioning that have high market cap. And then you got a lot of the little ones that are like, let's make money. And then, you know, they'll spin it and then try to make tokens and then try to create a speculative thing on the token side. So I like trying to separate the utility and what's actually happening and what's the value being brought. And then the token under that gets price discovery is one that in the longer term you go with, right? And then maybe you do make some money on SafeMoon and some of the other stuff. But like, you know, that's more of a speculative hedge. I wouldn't put everything in it, but so.
I was sort of going on the same lines with the practicality. What happens from a money standpoint when we're, say, being paid in Bitcoin, right? Let's say in El Salvador, and you know it goes up to say 200,000 this year, and you get that 85% drop, and it's 30,000. If I'm getting paid and I get $2,000 a paycheck, and 2 weeks later my money that I just got paid is only worth 300, is there going to be something that can fix that, or are you just out of luck and you just got paid 30% of what you're worth?
Yeah, so I think that's all comes back down to volatility, and I think it's the difference between the transaction at the moment when that transaction occurs and leveraging that network for that and then coming right into a stable coin, right? So if people are, excuse me, if people are using that as, you know, daily transactional, the behavior there is you're coming in Bitcoin, you're coming to probably a stable coin because you need it to pay your bills and you need to make sure that it's not like, woo, we can pay everything off today because it's up. And then, oh man, we gotta wait another week, you know, because it's too volatile, right? So from a currency standpoint, I think the first step is to get that out there because it's the most known, has the largest strength of network, and then you can use it as a payment rail to make a transaction. That comes into what's going to be eventually be probably the centralized stable coins, which we haven't seen that yet there, and that's coming.
Haven't seen it in El Salvador?
We haven't seen it anywhere, right? So you have Tether, you have USDC, you have GDAX or the GDBC, GUSD, which is Gemini's dollar, the stable coins, but you haven't seen it yet for like the China coin, US doing it, any of them doing any of that, right? And they were moving, they were trying to, and here I'm going to tell you, it's actually hilarious, but the reason why you haven't seen a government do it yet is even if it is centralized and you're using this tech, you ask the first question, why do you want to do it? Well, you see the network effect of having people just run nodes. Sweet, let's copy that. Let's run nodes everywhere. We're centralized, we are the authority. You can't manipulate it. Because if you got a counterparty that's running a node and it's centralized, and you're like, I gotta need to do a ledger entry. It's like, wait a minute, no. Like, my node's gonna say that you're doing something bad. You can't go back and change history. If you look at any major currency like that, the manipulation or the changing of things, it's like anything. Like in business, if you have a customer form in a CRM, and you put something in, you're like, that's wrong. You go in here and change a record. Now there's a change record somewhere for a little bit, and maybe that ages out, and you lose the history, the chain of custody. Same thing on any kind of currency manipulation or any kind of ledger updates or any of those accruals. All of that behavior would become transparent if they move to that kind of thing. I think everybody should move to that kind of thing, but you have no way. Everything now you're locked in. $1 is $1 is $1. Here's the transaction history between all these unknown entities, which are fine. They can be anonymous, but you can't make any kind of burns or credits or change. And this is where Tether really came into the news all these times because they were supposed to be backed 100%. And you would see the Tether machine print a whole bunch of Tether, and they're like, wait a minute, you just printed $500 million. Where is it? You know, you're supposed to be one-to-one back. You guys go out there and get a whole bunch of commercial paper to back all that you just printed. Even Tether in a decentralized quote-unquote world was still having to pay dirt on like, are we solvent? And then you had Bitfinex and all these folks that were pointing to it going, they're not solvent. Be careful if you're holding Tether that says it's worth $1. They were supposed to be back 1-to-1, right? So what says that any of that kind of activity doesn't happen in the central government? There's a huge risk that they take now that they move to that, because right now it's a black box. Kind of a black box. I mean, we keep printing, but like, I mean, we don't really know like the full total money supply. There's an estimate, right? This would now give you atomically information to show you that, because even if all those, you know, the centralized versions of that were only running at banks, and you as an individual would never run that, but your bank has to run it. For them to all be synchronized on the money supply, they all would have to have all that information and see all that activity. Because the way the nodes and the way the ledger works is the fact that all of it's in there. You know, now they could go something like Monero, or they could go somewhere where it's all ZK proofs, right? But I think you're kind of missing the point if you're trying to make a public ledger standpoint, if you're trying to shield all that activity, right? And then you run a lot of risk. Like Monero had an inflate bug for years, and nobody knew if that supply was ever got elevated and not, right? There's risk when you lose containment on being able to see if you have a problem. And that's part of the unfortunate problem when you have something like ZK proofs, which is just a way to shield transaction data. We're seeing that. We're going to see some of that. Somebody there.
Oh, sorry, I didn't mean to cut you off.
Yeah, yeah.
To circle back to the Lightning Network, so like with Ethereum layer 2, you can just buy the coins, like Polygon or whatever. Is there a way to invest directly into the Lightning Network currently?
Well, so it's.
You're right.
Yeah, you can. So Lightning doesn't have necessarily its own network. I mean, it's a company. It has investors, right? And from its development, I think A16Z. There's a few investing companies out there, and I don't think they're public, so you can't buy them. I think they're private. So if they are IPO, right, then you could get them on a stock standpoint. But they, a lot of these projects go where they'll run an IEO, IPO, like the initial exchange offerings, ICO, which is kind of turned very bad when a lot of ICOs kind of, took a lot of people's money, promised a lot of stuff, then couldn't get, anything done with it. Some of these other companies are funded by the small, they start small and then large companies come in and VC invest in them, right? So yeah, maybe at some point Lightning as a company could invest in it, but yeah, right now it's still private.
I was kind of wanting to get a feel for like the general sentiment among miners first with immediately liquidating your assets as you're mining versus banking them, because it is a very new asset. There's a lot of price discovery, and the general sentiment is that the market's going to keep growing and growing and growing as the years go on. So are you seeing more people kind of shift to that mentality where they're just going to sell enough to kind of pay for the power and then bank what they have now to sell, later on in the future?
Yeah, for sure. So like for our standpoint on the mining side, it was just sell enough to pay for power and hold, go long. Other farms, especially the publicly traded ones, have all been ticking up. I think now Marathon announced that they're holding everything. So they're not even selling, right? Which they're one of the largest. And they went from a model where they were only holding like 15%, right? And then they were selling and returning investment back to its investors. And now it's had so much price discovery, the investors are like, oh, just hold on, right? It's, we're looking for the longer term, and we'll borrow its capital. And you've seen a shift. And since 2018, the shift has been DeFi at the end of the day. DeFi, DeFi, DeFi. And what that means is now atomically you can take a position on your coins, right? You can put them up and then take a fully collateralized loan against them, right? So if you had $100,000 in coin, you can take $35,000 out as a loan. You pay 6.5%, 5% of which you're paying back yourself, right? So you're borrowing. If you need capital, you don't pay capital gains because it's like a 401k loan. And now you're getting just buying power. The difference is it's not derivative buying power or a promissory note. It is literally fully collateralized against that. And you're taking a TVL, a loan to value risk of 35%. So it would have to drop 65% before you get margin pulled, right? And you could put more in it to not get margin pulled. So you have now this at an automatic functional level. So like something through like Celsius, BlockFi, which is more of a centralized company, which allows you to transfer that money into one of those accounts and then borrow against it instantly. There is not filling out all kinds of stuff. I mean, with a BlockFi, you have to fill out all your KYC up front, right? Because they got to know their customer, they're registered in New York. I mean, you almost have to send a like thumbprint and everything to them now these days, but you have to like reconcile that up front. But once you're there, you send money to it, that money's instantly transferred back out, damn near in the same day, within 24 hours, right? So
Less than
less than
24 hours.
yeah. I mean, I know you've just done some of it lately. I mean, it's really quick by comparison to the. I mean, this is where it's going to completely upset the balance and just borrow money. Like, why would I ever go back to a bank and fill out all kinds of stuff? Right? It would be easier for me to just over time start moving assets into the crypto and then just taking loans against that instantly versus ever having to go and borrow against some other kind of asset. So the natural evolution of like, I hate to switch it back to like NFTs and that, but when you start to be able to atomically lock certain things, like a house deed, like cars and VINs, all of this kind of immutable stuff, your car VIN is what it is, right? You get that, you get a certificate on that, you put that as an NFT at some point. These are the things that are coming, right? And then now that will have some kind of spot value that you can quickly get a spot value on it and take a loan against it on the chain, right? And then now that's empirically tied to that. You know, that's probably less than 3 years out. So where now you're gonna be able to start taking things and not having to go through the traditional banking. Ironically, the banking, I think, is gonna come aboard to where you have FINRA, CFTC, OCC, all those different entities now getting that financial structure around it to where banks can participate. We've seen that start in October of last year. I was arguing on the channel saying, this is probably gonna cause a bull run. I said the day it came out, it was like October 16th last year. I was like, oh, OCC just gave guidance. That's Office of Control of the Currency. They're one of many components of it, but they just said banks should be able to play and change charters. The second they did that, I'm like, the banks can start to have hosted wallets. That's every bank in the country. So, well, it's credit unions, but like, it allows you to at least get that basic framework. And then lo and behold, we watched it go to the moon. And I think that structure kind of gets you there, is the ability to participate with that.
So going back to your question.
BBT Todd.
Yeah, BBT Todd. I look at mining coins. We take our operating costs, we sell that right at the end of, the beginning of every month, right, for the previous month. But everything else we hold. And I'll share a personal experience where I wanted to put a fence in my backyard. It was going to cost 20 grand. And I was like, well, don't really have the cash for it right now, but I can sell my Ethereum. I look at my fence now and it's a $2 million fence. So, long story short, I look at mining crypto as far as I think of it as like a savings bond. You gotta let it mature for a period of time. It doesn't have to be 30 years, but let it mature for a period of time before you start really cashing it out, because at that point, what's the point of mining? Because you're not really gonna get that far ahead. If you hold on to it, you have better odds.
Yeah, and I think that's why, no past guarantees future gains, TM, right? That's like always been a thing, but it's more of understanding that framework and the structure, and that's why I started in the very beginning of why it's important to understand why mining is important. It's actually the security of the network. So the more folks that do it, it secures the network, and that's a measurement all of us can see. And we see that difficulty going up, and we say the only way for somebody to disrupt that is to have more than 51% of that. And mathematically, the foundries of the world could not produce enough fast enough to take on that network. There was a critical mass change around 2015. There was like, if the governments of the world really wanted to disrupt this, they could have really put a pain on it around 2014. But the moment that started the climb after 2015, it kind of spiraled to where now it's extremely complicated. And this is some of the risks that you'll hear me bring up sometimes with Ethereum 2.0, and anybody going into a proof of stake standpoint, is the incentive models on something like proof of stake is that you need to have the node online. It
has to be operational, and you're making a relationship with the network as such. If you were a bad participant, they can slash part of your stake. In Bitcoin, in crypto, in current Ethereum, Ravencoin, nobody can take your stack, right? I mean, it's like you mined it, reward has been spent, it's in your wallet, right? There's no relationship I need to have with anybody on that. That becomes yours. If you look at Ethereum on 2.0, beacon chains out there, people are earning currency right now. And you can already go out there and look, some people have been not as active as they should have been on their nodes, and they've started to get slashed. They started to lose rewards. And I just think that that's not the final model. I think that they'll always be looking at that, and I think it's one of those things that the community will be like, I don't know, I'm not feeling that, man. And if you start to lose participation, people can adjust. But there's just a risk that the other risk that you have is where you host that. So you're gonna wanna go, I have 32 ETH in there, that's worth a lot of money, and I don't want that in my house because that's a lot of money and it's hosted. And I don't want the risk if my house burns down, I lose my key. I'm gonna put that 32 ETH in Amazon because they have a service level agreement with me that they're gonna keep that thing online, right? And you're gonna take that counterparty risk and you're gonna go to somewhere that you can sleep at night with, right? And if all of the nodes are all end up being just on the world's clouds because they're the most efficient, cheapest alternative to making sure your hardware stays online all the time, which is kind of what their point is the managed service, then does that mean the entire Ethereum network ends up running on all these world data centers? Which then now you're taking the one thing that is the strength of these networks and you're effectively handing it over to corporate large entities, which I build all kinds of systems for corporate large entities. However, somebody can go tell me to turn off the lights, right? So you're taking that one factor of those three key factors of immutability, no single point of failure. No single point of failure on that when you're thinking, oh, it's data centers all around the world. The G8 stomach can come out of there and go, turn them off. It's like it pulls a parlor on them and just shuts off the services. And even if you don't agree with parlor or whatever, it doesn't matter. The fact that you can shut down a company in one switch because all three major clouds decide that, nope, we're not Ethereum mining anymore. Like, not saying that that would happen, I think it would create all kinds of issues, but the fact that you're now reliant on the government making a good decision and the collection of governments making a good decision, right now there is literally nothing that they could try to go state to state. That's the great thing about the US. If you tell everybody to do something, not everybody does it all the time, right? States will say, yeah, we can have marijuana here. Other states just say no, it's federally still illegal, right? We've had it with masks, we've had it with vaccines, we've had it with everything, right? That's one of the good things. I mean, people are like, oh, it's bad, everything needs to go one way. But the ability to have that adjudication of process to try to get more information is excellent here. So if the government came out and said, no more Bitcoin mining, the governor of Texas would tell them, yeah, whatever, coming to Texas, right? Governor Abbott's already said it, Wyoming, Washington State, right? These are all very big areas that have Bitcoin mining, that have huge amounts of investment, that have brought in power plants, have re-brought in stuff. I mean, Columbus Mining did a video today that we should play in here before we leave. It's phenomenal. About the Navajo having to have on their property out in the west, and they've lost a lot of the coal power and they've lost a lot of income. Now they're Bitcoin mining, right? And it's like, hey, the kind of federal government as well as, mind you, I work for General Dynamics and I work for the Sky Air Force Base for you. I support the warfighter, right? Like, I'm not anti-government in any way, but I'm just saying government sometimes makes very rash and bad decisions when they don't understand everything all the time. And then they're like, oh damn, we messed that up, let's fix it, right? And what we're trying to say is that it's very hard for any influence at that level, even the US government, to make that kind of impact. And that makes the network very powerful. And I think that then folks start to understand the importance of it.
Yeah, I had a question on. Oh, thanks. I had a question on the Ethereum 2.0. I'm not super familiar with running a node.
Mm-hmm.
If the situation that you were saying with it being like on an Amazon Web Service, if they were to shut that down, could you then move your node back to a local state, or once that's on there, that's out of your control?
Yeah, so you could move it. So all the node is it's a replicate of the whole blockchain. And in that, it has a function in it on the 2.0 that ends up being a validator. So think of it just like an extra function that if you get the chance to mint, you have now the right set of functions to be able to do those things. And you're just validating. You're a validator now. You're just able to validate and then write down into your data source, right? If Amazon shut all that off, you still have your private key. So if they just power it down, you're like, oh, well, it looks like I need to go spin up a new node and just import my private key.
Okay.
Right? So you could rehost it somewhere. Like that's gone, and you can't get those VMs anymore. You don't lose your money, right? You still have your access to it. It's just the difference between like Bitcoin mining, where you could have it on a ledger or a treasure, and that's in a safe, and that public key is what you're mining to. Your private key is how you access it, right? This thing with like a door, like between these two rooms, right? This is the public room, everybody's in here. Private's back there and there's a door. I have the private key to get back there. If this goes away, I can restart this back up because I have the private key and I can recreate it, right? That's why it's important not to lose your private keys. Or the reference that is the 12 words. So that's just like a word problem that they use to translate those 12 words into that long key, right, into the hash. So they just simplified it because in the very beginning of Bitcoin, it's like, hey, remember this thing? Oh, where do you put that? Did I write it down wrong? Oh, damn. You go to try to, I've had that. I've had some, not just Bitcoin, like other older coins and stuff. Like Dash used to be called Dark Coin, and then it converted to Dash. And I had the original, like the launch of when it first came out, and probably lots, like 18,000 or so Dark Coin, which Dash is, it's like $500 or something now. It's quite a bit of money. But I wrote down that private key as an example. And I'm like, I've like created programs to cycle through that, like maybe, but then you're just essentially doing your brute force against it, right? So like switching that to 12 words was an innovation, right? Like now I can import my private key in that way, not lose those 12 words. So yeah, as long as you have that, you can reinstantiate it, but then if you're offline for a while, they can start to slash. It's a network participation.
Excuse me. What would you recommend for anybody trying to get into mining now? Would it be like a ASIC like they have available here, or GPU mining, or what coin per se?
I always like, so going to the ASIC, so it's this weird catch-22. The ASIC's very expensive. So you got to kind of be committed to it. The good thing is you probably resell it and lose next to nothing. But the ASIC is a high barrier entry, $14,000, $15,000 for an ASIC right now for a Bitcoin ASIC. You can find some used ones, but again, it's all about the power, the hash rate that you have versus the power, and there's a calculation that you can figure, is this efficient or not? So there are some ASICs out there that are like $7,000, and you're like, oh, it's 54 mega hash, or 54 terahash, 76 terahash at almost the same power as these. So you're inefficient by comparison to that. The ease of use on that is super easy. And when I say super easy, literally, you could have very limited experience and just watch a tutorial, stop, go, and get it set up in a night. Essentially is you boot that up, and it's like a little tiny web server. So you plug it in your Ethernet, and if you have next to no experience on it, it's gonna have a thing to go to this address. So you open up your web browser, you point to that web address that thing's broadcasting on, and it's gonna come up with an interface. It's gonna have you log in. They have the username and password to get into it. And then you literally just give it an address to go to that pool. I mean, if you go to any of the pools, if it's Slush's pool, if it's, you just look up Bitcoin mining pools, Luxor, they have a help start and just literally step 1, step 2, step 3. Put your Bitcoin address in there. You can get that from your Coinbase. You can get that from any of your Bitcoin, wherever you want that money to go to. If you download Coinbase, have that go there. I recommend we help uphold, really is what is a good one. Exodus, if you want to keep it offline, get a Trezor. You're going to need where the miner's going. So it's where it's pointed to send its hash rate to, and where to pay you. Just turn it on, it's going to get loud, and it's going to run. And you're going to see it running, and then that's it. That's really all it is to it. Go to a website, add a few pieces of information, and you're up and running. And it's very reliable. It will run 24/7, 365 for 3 to 5 years without any issues. Almost all of those Bitmain ones. I mean, those S9s have been out since 2016 or so. right? And they're actually still profitable because, again, they could not build equipment fast enough before the price got high. So that's why all of this hash rate's on there. Where people find me is usually on the GPU side, just because the barrier to entry is a little more complex on the tech side of it, but it's way cheaper on the cost of entry, because you might already have a computer with a graphics card in it. And getting that understanding of how it works, how a wallet works, if you have no experience, it's really nice that you could just get that one machine that's probably not going to give you a lot of money generation, but is working, and you get your first payout. That's that first experience, like, okay, I can do this. Now I just need 7 of them, and then, you kind of scale it up. And that's the way it's a crawl, walk, run. And once you get comfortable with it, because then you won't have that huge investment of cost. You want it, maybe just a little bit of time, and you feel proud of yourself being able to accomplish it. And I mean, I get all kinds of emails like, man, I did it. Like, I can't do anything, but I did this, and it's like, I'm like, no, like, congratulations, man. Like, you found the video and you're able to do it. So, yeah, I mean, starting with like a GPU or even CPU, everybody has a CPU at home, right? Your laptop, starting even CPU, it's the same set of processes. It's just the program, the miner programs may be a little different. That has a miner built into it. So it's you don't have to download anything for that. It's already on there. It's ready to go. On the GPU and the CPU mining, you have to download a piece of software on your computer, and then you have to configure that to the address and the address to where you want to send it and where you're going to mine to. And sometimes that's really tricky. We even said BBT Rager, shout out BBT Rager. So he's been an intern learning, and Ray didn't come, he heard around crypto, but hasn't had a lot of experience when we first started. And he was kind of my test, like, completely new slate, how quick can we do it? And I think you're able now to catch most of the issues on the syntax side, if we have something misspelled or we're missing something. And then cradle to grave building the machine we did a Newb Series recently. Literally day one, Newb Series, fresh start. And I think we got through like 9 to 10 of them. So in each one of those, ranging from an hour to a half hour, it was probably about 9 hours worth of physical work. And then he was already building it and mining and doing all this. So that's starting with no experience, so about 9 hours of quote unquote investment of watching, where I think you'll pick it up. Which is really, I mean, the key to permissionless financial freedom, to at least get some trickle and start that in 9 hours. I mean, it's not going to turn around and make you a millionaire right away, but like maybe in 3 to 5 years we'll see. Like, it might be a lot. I mean, I had these conversations back in 2013. I did a talk like this in 2014, and at that time it was like, just buy one Bitcoin for only a couple $100. And like now it's obviously a lot more, but that's the same way I look at like something like Ravencoin, which holds a lot of the same kind of principles as Bitcoin. It was forked from Bitcoin. My license plate says hodl Raven. I mean, I'm pretty long on Raven, but I look at it because it reminds me of a lot of the early days of Bitcoin. It's taking Bitcoin's base code line, so they inherited all that security from just the code reviews and stuff like that, and then they wanted to make an asset system. So they made the folks that were involved with it. Patrick Byrne, he owned Overstock.com. He funded the Ravencoin development team. And his concept, he was done with the way stocks and stock traded options, STOs, all of the things that are in the stock market. He was tired of all the commercial paper and all the back end kind of screw people over. And he's like, let's take what happens on the stock market and let's put it into functions within a cryptocurrency. So Ravencoin cloned Bitcoin's base code, and then made changes and added asset management, nested assets, ST stock traded options, all those things on Ravencoin. And it just took the numbers and went from very loud. So even if you have it in your garage, you'll hear it. You'll go, like, what is that noise? They're loud. So where they go is going to matter. The GPU mining is a lot cheaper, or a lot cheaper on that, and they don't put out near the sound, but they put out more heat. So if you put 8 GPUs on a machine, it's going to put out more heat than that guy. It's quite a bit, actually. Like, one will heat a room up pretty good. Like, actually, I can't think of the last time I've actually had it in the house.
So the farm, on the farm, there's like 2,000, almost 2,500 video cards running. Outside temperature was minus 10 degrees last winter. No heat was running except for the miners, and it was 55 degrees inside the farm, to give you an idea.
How many square feet is the farm?
That portion is about 4,000 square feet. So,
Yeah, that was the fans just pulling in that cold air, and it was heating it up from -10 plus whatever wind. I mean,
yeah.
Relative.
At that point, there's no. It's not like trying to suck up any air from the outside in because it's already cold enough. But yeah,
It's
it's
still
able
moving.
to keep it going for 50 degrees inside the farm. I mean, that's a lot of heat.
Yeah, it's heating it up. Yeah, so you gotta worry about your heat. To that point too, I mean, it depends on what you're mining. So Ravencoin is very task intensive on the GPU. It's going to use core and memory. So if you think of a GPU, the whole purpose of the GPU typically is to make graphics on your computer go fast. And if it's gaming or any of that, or any kind of CAD work or any of that, it makes it faster. Then you have two main components on the GPU. You have the core and you have the memory on that GPU. And the memory usually has an amount of space, so it might be 8 gig, 4 gig, or something like that. Ethereum is memory intensive. So the way Ethereum's algorithm works, it really matters on memory. That's why you'll see some GPUs that are like pretty cheap and they do pretty good mega hash because they have fast memory. So it doesn't use a lot of core. You can bring the temperature down because you don't need to run them as hard. Ravencoin, it uses core and memory, so it does generate more heat. But you don't need to run them that hard. It's kind of like you have a Ferrari that can go really fast, but you don't need to have it all the way down, right? So you can slow it down a little bit and still get places with it. You're just going to take a little hit on your total mega hash for not having to put out a whole bunch of heat. So most folks get about 4 to 6 in a house before they start having to figure out what to do with heat. They're like, hey man, this has been great. I have 4 rigs. This is my 5th rig. Now it's like 90 degrees in my house. What do I do with this heat, right? People with fans open. I mean, the first time we had all the rigs down in the basement, 2013, it was hot down there. 93 degrees in my basement. And it was about 10 degrees. And I had box fans in the window. And my neighbors came out, they're like, why do you have 4 box fans blowing in? And I had on the other side of the room, box fans blowing out. And I'm like, I need to move like 80, 90 degrees with the temperature. And then literally, I think a few days later, we had the police department show up with the power company because they didn't understand why we were using so much electricity. And I walked them down there and had this kind of talk for about 25 minutes with the chief of police and the Southwestern Electric. Like, no, here's what I'm trying to do. And then I had like the Southwestern guy giving me like, oh, you need to route this there, here. I mean, it was great, but yeah, you will hit a point in a house. Most houses have 200 amp. Each of the mining machines, like the GPU mining rigs, will use anywhere from 800 to 1400 watts of power. So if you think about it, that's pretty much topping out a 20 amp. The 15 amps is about 13, most you want to put on that. Most folks usually bring in a couple 30 amp circuits into the basement area or something like that. That'll give you, about 5,400 watts of power per 30 amp. And you get a PDU, a power distribution unit, that'll allow you to kind of distribute that. So you can get usually around up to 8 rigs in a house, and then you're going to be topped out. Because if you go any more, what you'll end up doing, you'll end up clipping some stuff because you start running like your dishwasher and all kinds of things, and then you're running also like 8 rigs in the house. I've had people say, "Oh, my main flip," at around that.
You want to run a dedicated circuit for your mining equipment. Good friend of mine let me live in his basement. I brought a bunch of rigs in, brought them down to the basement, plugged them all in, turned on the television, went upstairs, had dinner, and my friend's like, hey, do you smell smoke? The television running just overloaded the circuit, and I actually burnt the wires in his
throughout
room.
the whole thing.
Yeah.
So yeah, you want to have
a dedicated circuit just for your miners. That way you're not worrying about the wiring that's in your wall. You're not going to worry. I could have fried the television. There could have been all kinds of other damage.
Yeah, I mean, it comes down, and there's a lot of, we learned a lot of lessons back in 2012, 2013, of what to not do. And that was some of the first videos on the channel was like, hey, this is what can happen if you do certain things. But yeah, it's just doing it, 1, 2 rigs, probably you're fine on just what you have in your current setup, because they don't use as much power as those units did back in the day. I mean, those units were around 2,000 watts, which you're right at the top of the 20 amp. I mean, you'll probably end up popping it right at 2,000 watts by 1,800, so it starts getting really warm. But yeah, you'll want to have a dedicated 30 amp. Like computers and computer power supplies will work between 110 and 240, right? You can plug them in and they'll do the switching, right? So the only risk is if you have that in an area where you share electricity with other things, you gotta remember, that's 240, right? And I've burned many things up, plugging them in, like, oh, let's bring this lamp over here, wow, you know, and you put 240 in it. So you'll learn some of those lessons when you're doing it, if you're doing a home setup. But, you know, I would always say start small, start at your home, understand what's involved. Don't go straight to go and buy a facility and any of that. There's a huge amount of cost up front on that you're not going to realize right away. Partner up with people that are motivated and want to do the same thing. You're not alone. And it's different. It's different than the typical business relationships because everybody's going for the same thing. You're not alone with like hearing best practices. I mean, almost all this stuff's free online. I venomously opposed to charging for that kind of stuff online. I will tell everybody everything all the time for free on it because it helps all the network. That's why all the YouTube videos are free. You know, because we all share in those best practices. I can't tell you how many people have reached out to me and like, hey, we watched the video and how you guys had something set up. And you should probably think about doing this for the farm. And it's like, man, that's like privileged information that you've used for 30 years of experience running power and you give us a better solution, right? I mean, like, that's where it comes. It pays back in the weirdest of ways, right, on that stuff. So just, you know, tell people, I mean, there's obviously a ops security thing that you have to be careful about, not letting everybody know where your farm is and all that stuff, but just, you know, like, be smart about that part of it, but like, and who you're doing business stuff with. But yeah, definitely partner up if you can with stuff, because a lot of people are into it. And it's always nice that if you're out of town, you got somebody else. That's what Todd and I have done for years now. Just like, I'm out of town, like, I got it, you know, and we'll take care of it. So you have somebody else to rely on that understands the pains of running a farm. And it's like this weird, like, Mr. Miyagi wax on, wax off thing. You don't realize all the things you're learning in this space and all the architecture stuff that now is applicable to a whole bunch of other potential new services that are going to be out there. You know, work and stuff. I mean, we're growing right now. I'm growing the team. We're building out other managed service stuff to help other farms get situated, get audits done, help people find the source equipment, all those kind of things. And it's amazing how many people have reached out and like, hey man, I've been working doing my own thing for a while. We want to come work and do some of this stuff. So definitely look out there. You know, Jeff and some of the folks here at Crypto World will probably point you in the right direction and who to work with if you're looking to build out something, that kind of thing.
We got about 8 minutes, so a couple more questions, guys.
Yeah, sure. Does the first tax liability come when you either exchange into another coin or actually cash a portion out?
Yeah, so the government did an interesting thing on us. So if you're a miner in the U.S., technically your mining income is AIG. So if you're earning income, you pay tax on your mining income. Any that you hold after you've paid that tax, from that point, I paid my tax, I'm holding this. Well, that now creates a new cost basis until you make a new transaction and you pay capital gains on that, right? So your mining is, they look at it like, and I had this wonderful conversation with IRS on this, just not because you were coming after me. So I do a lot of consulting, including sometimes with the government. Bottom line, they see me do this stuff, like I've given talks for the Secret Service, for here at St. Louis at Centene, for U.S. Marshals, for folks that are doing enforcement. It all comes back down to just asking questions like how things work. So when I've had the ability to ask them other questions like, well, why are you guys doing it like this? They look at it like these machines are working and they're earning an income. And that income is like if you were working and earning income. So now they can tax that as AI on your AIG and your income side. And then anything you choose to hold now creates that cost basis as if you made an investment, you want to hold it. You just happen to not make another transaction. right? And then from that point, as you pay tax from there, creates cost basis, and then on, and then when you go to resell it again or trade, you create your deltas there. Now there's a lot of cool tools out there now, and they're getting better. We use QuickBooks for stuff, and I was just having a conversation with them to figure out if we could start accepting crypto in some way with them. They're working on it, and they're doing a lot of stuff on the tax side to help people. Bitcoin.tax is a really good website that has a tool, their software as a service, that allow you to go in and create a share key with your different exchanges. So you're not giving them access to the exchange, you're just creating an API exchange with them for them to read only your transaction history. And then it'll do all your ins and outs. And what it does is it'll give you an estimate of what you owe for tax. And then you'll go in there and go, no, I transferred that off on this transaction, right? So you got to go in there and adjudicate, you know, if you've transferred out of it and you haven't sold the position, if it leaves an area where they don't know, they treat it as tax. And that's the same way with the IRS. They're not necessarily going after it because it'd be just mind-boggling to try to do that right now. So they're just going after the big folks right now on like that have to explain some transactions, you know, if there's a large transaction that hasn't been reported. But like Bitcoin.tax will keep all that in order. They have that online service. They have both online and offline versions of it. It's super cheap. It's like $29. Totally worth it if you're trying to keep track of stuff. You know, that's what I usually recommend to people.
It creates your tax forms for you.
Yeah, it creates your tax forms for you. And I mean, like you can go back and forth with IRS, like, hey, I'm using this. They actually recommend that. So, because they're using I think the folks that built it actually were a few ex-IRS folks with, you know, a guy that came from one of the large tax firms in New York that just came in and was like, let's build this, let's tackle this. And they got a couple of Bitcoin developers to teach them how transactions work. It does it across most of all the different types of monies in the exchange. So it doesn't it doesn't care if it's Solana or if it's any other currency. It's literally looking at cost basis of what's price, what's your transaction, what's the delta, I don't care what currency. It just happens to have a token ID there, right? They're just doing the math on the deltas and the different currencies.
Bottom line, keep good records.
Does it allow you to write off your electric costs?
Yes, so absolutely. Write off all your expenses when you're mining. I mean, that's just to depreciate your gear. So usually there's a really good calculator. And we'll make sure on some of this when we post this video, I'll put these out there. So if you're like, damn, I wish I had a pen, we'll make sure we always go back and watch some of this. That's why we record it. We'll make snippets of that. And in that, in the description in the video, I'll have links to a lot of these things I'm talking about. So don't worry if you didn't write it down. There's a couple different tools that allow you to keep track of your expenses on that and what to keep. So there's a punch list of things to make sure you're writing down. The calculator tool is called the Brains calculator with 2 eyes. So if you literally type Brains with 2 eyes, space calculator, you'll find this really cool tool that allows you to see like depreciation. You can do it over a 36-month schedule. It pulls in like Bitcoin price, and if you're doing like a Bitcoin mining machine, it allows you to see what's my depreciation over time, what's my estimation if I have 2% of Bitcoin price discovery with 2% of Bitcoin, difficulty. They're supposed to be adding other tokens in that calculator, but it gives you a forecast at least, or like a 36-month schedule to figure out, should I depreciate over 5% per month, and what are those numbers that I should be calculating? And it exports to CSV, which is money. So you can get a lot of that already there. So there's a lot of really cool data-rich tools now. The cool thing about record keeping versus anything else is, it's on the chain. So like it's all on a blockchain, so it doesn't go anywhere. So exchanges are your only delta, like if you lose access to it. I mean, I know that there's some issues sometimes. Folks send messages to me, or especially around tax year, and they're like, hey, I think I did transactions on this thing called Bloniax, but it went away. Am I still responsible? I'm like, probably. So you're probably trying to get access to Bloniax. But yeah, so sometimes the weird things like that happen, and that's one of the things I've explained to IRSCI, which is the criminal investigation side with them. I went out and got Chainalytics certified, which is Reactor, so it's a way that they do telemetry. And when I go back and we give a talk to them and stuff, I try to explain like, hey, you gotta understand, like sometimes these exchanges are, I don't call them fly by night, but they just disappear. And they take the people's money with it. So like, how do you want them to report that? Huge law, I mean, so like it's still a very, I wouldn't even call it alpha anymore. It's probably now into beta. So we'll work with you. There's also this thing that you call safe harbor. So just Google safe harbor. So if you're making a company in this space and you are trying to accept cryptocurrency, read and understand the safe harbor laws to understand that you're falling and complying with that. It gives you the ability to operate and innovate in a gray space. Because like a lot of this stuff is not regulated, right? So if your past history is really good with, investing and finance and private equity and all these things, you're like, you know what, I think I understand enough to make a small fund. How would I do that? And what if there's a Cayman's account and all that? You can follow safe harbor rules and figure out like how to structure within that, and then just report, hey, here's all this in fair transparency, how we're doing it, and then just innovate and start to build a solution around that, and then just fall within safe harbor, and to make sure that you might get called for discovery of figuring out like how you did it, but as long as you're just operating in some level of transparency with that, I think it's that safe harbor will keep you in order.
Mike, can we expect a change in the laws that Congress, I know Congress has been working pretty hard at the miner, the tax laws for miner. What do you know about that?
Yeah, so there is one going right now through the House. It's they packaged it in a damn infrastructure bill. It's like an earmark thing. Yeah. So like there was a lot of pressure on the Senate side. There's actually senators that are very pro Bitcoin that are trying to push it. I think what's going to happen is they're going to push the infrastructure bill in no matter what. It's going to get indirectly pushed in. It creates a lot of pain as it's written for a miner, and it really separates like a US-based miner versus everybody else, which automatically throws everybody to be able to fight it to say, hey, you've now disenfranchised us as miners because we have to report differently than the rest of the world, which thereby now we cannot compete with the rest of the world. So I think there's enough structure in place that will allow folks to fight it. And then mind you, all of the stuff that's in the infrastructure bill with regards to this doesn't kick into effect until 2024. So there's 2 years at the time that they rubber stamp it that they can just redact it or amend it, right? So I think the effort is really going to fall. There's a few people, and we'll put on there, Jason Travinsky, that is a person on Twitter, used to be a tax SEC lawyer, really, really good, loves explaining everything on Twitter through Twitter storms. He is all over it. He's a must follow on Twitter. I follow him on there to understand. He just posted a 8-tweet storm on here's what's going on, here's when it's going to happen, here's the next steps of what we're doing. And they're really working with Coin Agenda, which is, I would call it industry government affairs, of anybody that's working a big company type of thing. So there's a Bitcoin version of that's industry and government affairs that goes and tries to lobby on behalf of Bitcoin. They're the ones that are getting up with Congress and sitting down with Congress and explaining meticulous details related to some of the rules of why it's bad of what they're trying to do. I have good faith that they're gonna do it right. The government's asking the right questions. They're coming to some of the events. We had Crypto Coffee here a few days ago. I was talking about first time I actually see government show up to some stuff. They started sending the FFRDCs out there. It's federally funded research and development, which is MITRE company as an example. They're a nonprofit. They're there to do discovery and try to understand the space. They're out there doing that in the background. So it gives me enough understanding that as long as they understand it and can translate it, it'll get the right language into the law. I think it'll end up changing it. I think this was just, let's get it in there quick and then get this thing pushed through and try to disrupt it. Because nobody knew what was going on with China. And when you look at when the infrastructure bill was coming out, you had China 70% shutting down. Oh, this must be bad. Let's lock this out, right? So I think it was done in there late. It was snuck in at the last minute, and it got into Senate, and they weren't able to stop it. So I think it's just going to get amended.
Well, and this industry is going to be 20 years ahead in 2 years anyway.
Yeah, it's Fidelity. The second we can go into open enrollment, when you go to do your open enrollment in November and you select, 30-year fund, 40-year fund, and all that, the second they add that tab for cryptocurrency, and Fidelity Financial's doing this. This is what they're building towards. They could do a large team that just expanded. The second you can add a crypto fund, and it's a blended mix of them, next finish is going to be the biggest bull run history in crypto. Because you're not taking new money that we have is, how do you want to invest that? You're taking money that's already invested.
Trillions.
And I'm not saying it's easy for people to make decisions that already have a 401k, but if you can say, I'm going to take some of this and I'm going to move it over to this button, next, finish. And now you've transferred wealth out of some of these funds into crypto, then you're going to have a huge run on that. That's a lot bigger.